I don't want to chase shiny objects. I was a certified shiny object chaser for years. If I would have invested in 5 out of 745 deals in 1999, it would have been the first 5 I'd have looked at because they all look good. And I was an idiot. And that's just the truth. The shiny object chasing, the converse of that is staying in my lane. One of my business partners ran for governor of Colorado in like 2017 or 18. And he rubbed shoulders with billionaires. And he realized, and he told me, he's like, they're not like that much smarter than us. Their education wasn't that much better. They just stayed in their lane for decades. And they were willing to be boring investors.
I am Christina Suter, and this is the Real Estate Breakthrough Show, where we talk about the reality of real estate, the mindset you need in order to face the reality of what it is, and tips and tricks to get you moving forward in investing. I am your host, Christina Suter. Hey you, this is Christina Suter with Real Estate Breakthrough, and I have Paul Moore with Wellings Capitals with me, and I am grateful to have you, Paul. I always feel like anytime you show up at my meeting, on my podcast, just being willing to have a phone call with you, I am grateful for your time and your focus. You have such a depth of experience and such a gentleness of nature that I just so relate to. I want to be Paul Moore when I grow up.
Oh, I doubt that.
I want to be you when I grow up, Paul. And I'm already kind of old, so I have a lot of work to do very quickly. No, I really, really, really appreciate your depth of history and how generous you are. And so thank you for gracing us with your time and your focus. And
thank you. And what an honor to be here again.
Thank you. All right. So Paul, why don't you real quickly, so that people who are not as familiar with you as I am, go through your background, your bio, just so people can get grounded in what does Paul Moore do?
Yeah. Well, going way back to the 80s, I got an engineering degree, which was my first big mistake. Then I got an MBA, went to Ford Motor Company for 5 years, had my own company for 5 years, sold it to a publicly traded firm. And I thought, hey, I'm a full-time investor. That's pretty cool. And I wasn't. I lied to myself. I didn't know the difference between investing and speculating. And I became a full-time speculator is what I did. And I made some money doing that. And I lost a lot of money doing that. And I gained a whole lot of experience, as they say. And got into the real estate game in around 99 and started investing in oddly enough, the first deal was commercial, but after that, just, about 12 years of residential investing, flipping houses, flipping waterfront lots. I built 7 or 8 houses, and I learned something super important for your listeners, that if you don't know how to tighten your own doorknob, you shouldn't build a house. I'm just saying that.
No, that's good. That's good. No, there's a lot of depth to that comment that I'm actually going to let go past this time, because I don't have you. I only have you for 35 minutes because there's so much knowledge in that one statement. Go ahead.
Oh, there's so much. But at any rate, in 2011, we pivoted to commercial real estate, and actually, going fast forward 14 years now, we have eight different funds at Wellings Capital. We are investing in self-storage, mobile home parks, RV parks, multifamily, light industrial, and occasional commercial retail centers.
And that's funny to me that you've gotten so diversified, because I remember back in the day when you were the multifamily man. That was what you did. That was what your first one, I think it was your first book, or what your most famous book was multifamily, and how do you do that? And, everybody's like, oh, you want to have Paul Moore because you're going to talk about multifamily. And then there was a point where you turned from multifamily because you were like, hey guys, this isn't the asset it used to be. And then you actively, consciously made the choice to move to a more successful asset, not just because of your knowledge base, but more successful because how it's behaving in the market.
I wrote a book that was humbly titled The Perfect Investment. And about 3 years later on Bigger Pockets, I had a little show there and I did a lot of blogging and started saying, time out. The perfect investment is not perfect if you have to overpay, over leverage, use risky floating rate debt, and believe that trees, AKA rents, will grow to the sky. And all that stuff had to happen to make it work. And so we pulled out, and honestly, we said, you know what? Why don't we take a different approach to this? Why don't we try to find asset types that have a lot more mom and pop operators Those assets can be acquired, improved without a massive dogfight, driving prices 35% above what they should be. And we found a lot of success with this model.
And I think your conversation said very quickly, but it has a lot of depth to it, is, I remember when I bought my first apartment building, it was cash flow. It was a 7% cap rate. My interest rate was like 5.5% to 6%. I had positive arbitrage on it. I put, 35% down because the bank required it. It was a cash flowing investment. It was my first apartment building. It was small. It was like, 18 doors, right? And then I remember after 2009, when multifamily was the first to recover, right, in that downturn, because a lot of these smarter, older investors like you said, hey, wait a minute, multifamily is something where all these people are going to go who are losing their homes. They're going to go into rental units, so let's buy rental units. And the cap rates compressed so tight that the cap rate was below the interest rate, the actual cap rate, not the promoted cap rate. The actual cap rate was below the interest rate. And then I'm like, well, I'm newer to this, but I don't want to buy into multifamily because I don't want to risk that. And I didn't know enough to do negative arbitration and to over leverage and to be really confident that I could do rehab that would drive rents up to the sky. But I appreciated when you said years later, you were like, oh, I've noticed. And I went, hey, I noticed too. And I'm like, a lot younger in this real estate field than you were at the time. And I think there's something to that. And you actively, consciously, and intentionally took your wisdom and moved over to a different asset class based on the numbers working and based on the lack of competition inside that asset class.
There was more to it than that, though. We looked as investors ourselves and we said, what do we want? And we wanted two different things that both happened to have a D in front of them. One was broad diversification. And the broad diversification meant trying to find the best in-class operators in a lot of different asset types. But we also wanted deep dive due diligence. We looked at 745 deals and operators last year. And you know what, Christina, it's amazing. Every one of them looked great up front. They all looked, like they all had beautiful websites and glossy brochures, so to speak. And they all looked like they were really good. Well, we only invested in 5 of those. And that's 0.67%, less than 1%. To do that level of due diligence for the average investor is just daunting. And we have grown a team of 4 people who are just evaluating these deals. And so if we can get broad diversification, I said it again, and then deep due diligence in the same investment, the only way to do that I know of is to have a fund of multiple different operators and asset types. And that's what we did.
You're hitting on something so important. I mean, just the numbers themselves are so telling. Over 740 looked at. You only invested in 5, I think is what you said. And they all look good on the surface, right? And so for the newer investors that are, listening to this right now, I think that alone is the lesson of they all look good on the surface because we all know what the marketing needs to look like. We all know what the target return needs to look like. We all know what the preferred return should look like. And then you take the deal and you morph it on the back end to try to create that. But does that morphing on the back end to meet that market expectation actually destabilize the deal?
Well said.
Right? So then you go, and then, and it's the same with some of the history, right? So you are looking at the deal and you want the deal to be stable, but you need to do deep due diligence to understand that. But then you look at the history of the people who are running the deal. And again, I'm going to say something that, well, it's accurate, but it's not necessarily said positively. There's 4 of us running the deal. And between the 4 of us, we have, 40 years of experience in real estate. And I'm like, okay, so that's 10 years each. Right? It's using the marketing to shift the perception versus understanding what's underneath that. Oh, they have 40 years of experience. They have 10 years of experience. Some have 5, some have 15. And the depth of experience that you can see at like a Wellings, Capital, Paul Moore, I'm sorry, but I hold you as one of the anchors in our field of having this deep depth of experience over decades, enough to do well, do badly, do well, face another downturn, threaten to do badly, like the reality of the grit it takes to exist in the field. So what is some of the things that you feel like you brought to the fund of funds? What's some of the skills and knowledge, natural talent that you bring that helps you run a fund of funds successfully?
Well, a lot of this came through huge mistakes that I made and that we made early on. And a lot of those mistakes, because they were painful, they turned into assets now. And that's one of the benefits of being 61 years old. You've got that time to actually turn your mistakes, your failures, losses into something positive. But it took a lot of that. And so I made one comment earlier that was, I was not an investor, I was a speculator. Well, now that makes us more committed because of the pain, losses, because my wife reminds me of all the money we had that we lost, 27 years ago. That pain now morphs into being intensely focused on being an investor, not a speculator. And, it even goes down to cap rate compression. If somebody's buying a deal at a 5.5% cap rate and they're assuming, it's going to compress to 5% when they exit in 4 years. That may be true, but we cannot. That's speculative to add that into my profits. If it took that compression to make the deal work, like you said earlier, they morphed into something that was, what'd you say, destabilized. I love that. Yeah. And so we don't want to speculate. I don't want to chase shiny objects. I was a certified shiny object chaser for years. If I would have invested in 5 out of 745 deals in 1999, it would have been the first 5 I'd have looked at because they all looked good and I was an idiot. And that's just the truth. The shiny object chasing, the converse of that is staying in my lane. One of my business partners ran for governor of Colorado in like 2017 or 18, and he rubbed shoulders with billionaires. And he realized, and he told me, he's like, they're not like that much smarter than us. Their education wasn't that much better. They just stayed in their lane for decades, and they were willing to be boring investors. Boring investors don't try to get the same charge out of being a long-term manager and an investor that they did out of being an entrepreneur up front. Being an entrepreneur up front has that huge, steep rush and learning curve and 80-hour weeks and all that stuff. But, when Bill Gates said no to 10,000 distractions to say yes to his one thing, or Gary Keller famously in his book, The One Thing, they stayed in their lane. They stayed focused. And you might say, well, Paul, hold on a minute. You're doing like 6 different asset classes. Well, not really. We're doing due diligence on other people who are doing 6 asset classes. Warren Buffett said diversification is for people who generally don't know what they're doing. And I was really puzzled by that. And then I thought, wait a minute, Berkshire Hathaway is the most diversified company in the Fortune 500. How can he say that? Well, it's because he's saying diversification within one operating unit or one company is foolish. Like if Dairy Queen, which they own, if they decided to not just be specialists in ice cream, but they wanted to go out and make the cartons, and they wanted to get a printing company to print the ink on the cartons, and they wanted to buy a million acres of forest to get the pulpwood to create the cardboard, that would be stupid diversification. But Buffett, he has 28 people in his company. That's it. And they're a Fortune 7 company. And those 28 people at headquarters is what I meant. They run like 107 different investments. And those people on the ground are the experts. And they're all staying laser focused. And that's what we want to do at Wellings Capital. Another thing is, we realize we might be wrong. I remember standing up once with a room full of friends in 1998 and saying, this new business cannot fail. And of course it failed. And, now I realize, hey.
I love and fear those humbling moments.
Oh, it was a great moment. My friend still reminds me of it. And, But we realized we might be wrong. We realized that we might make mistakes. Charlie Munger, the smartest investor in the world, according to Bill Gates and Warren Buffett. Charlie, we lost him about 18 months ago, but they said he was the smartest investor in the world. What does he focus on? He focuses on not making mistakes. And there's a whole lot there, like you said earlier, a lot of depth to that. Instead of creating the most complex algorithms and trading strategies and deep, complex, programs because he was smart enough to do all that. Instead, all he did is he studied other people's mistakes and he was obsessed with not repeating those mistakes. As a result, Berkshire Hathaway's stock price could lose 99% of its value, meaning if it was at $100 a share, it could go down to $1 a share and still beat the S&P 500 by at least 40% over the last 6 decades. Think of that.
That's outrageous. That's an outrageous yes. I mean, I believe you. I believe you're capable of doing the math. So I believe the conversation. But that's an outrageous thought that he's able.
Outrageous. And that they did that by focusing on not losing money more than focusing on making money. And so there's so much there. I'll take a breath real quick and you can ask some more questions, but those are some of the lessons we've learned.
No, I think that, when we talk about the secret sauce of your company, there are people where their secret sauce is their amount of grit, their amount of, I don't know if grit's the right word, but like the enthusiasm, the willingness to dig in. They're going to take on a complex project. They're going to take that down. That can work. But then when you talk about being a boring investor, having decades worth of investment, right, experience and history, then you start applying that. Right. Then you're talking about, well, what's the secret sauce of your company? Kind of can boil down to what's the secret sauce of Paul Moore, right? Which you've said early, which is the depth of diligence. It's not necessarily just the fancy project management or the apartment buildings that you own. It's the fact that you have a funds of funds. You now are relying upon one, I'm going to guess, one of your strengths, which is, I'm going to say this, your geekdom. Your willingness to be a geek. I often claim being a geek, but the willingness to do due diligence with a depth of understanding of what that diligence means. Because everybody's like, oh yeah, we always hear do lots of due diligence, but there's a depth understanding that diligence.
Yeah, I mean, for me, it was just knowing what I didn't know, knowing what I'm not good at, but realizing, again, from pain and suffering, that I needed those things, and we hired the best people we could find in all those arenas. Another thing is we were willing to forego profits today for tomorrow. That aligns our interests with investors, but it also meant, I know I'm going to step on so many toes here, but for us, I'm just saying for us, Wellings Capital, it meant saying no to other things outside of our main focus. I mentioned not chasing shiny objects. We were so close to going out and selling the ATM investments and the carbon capture and the debt validation funds and stuff, that I sat with a wonderful investor of ours who came in from Dallas last night. And he told me how many of his friends, including him, had lost money in those things. We were really close to selling all those. And we could have been, I could have paid off my house, bought a nice car, bought a vacation home. I am so glad we didn't do all those things. They were outside of our lane, not to mention the other things that happened later.
Yeah, I was going to say I happen to know carbon capturing and the ATM investments, which we belong in similar circles. I know what happened to those, and I know that they didn't work. And in the end result, they imploded. And it imploded at a cost to a lot of investors.
Yeah, and it pains me. A lot of those are my friends.
Yeah, including me. I was never in the carbon squad, but I was in the ATM one. So I was in there, and we've lost that capital, probably 100% now, because it's still being sorted out. But I think it's important to understand that your lane is the due diligence. Your lane is being able to say no. Your lane is being able to see when they've morphed a deal to the point where it looks really good on the surface because the high numbers look right. So what are some, just to educate us, right? Give us some quick tips on what it is that looks like red flags to you when you're looking at a deal. Just a couple. there might be 50, but let's, I don't want you to have to think of all 50.
Well, an obvious one is not having skin in the game. If the operator doesn't put a lot of their own money that they have to write a check for, not talking about the acquisition fee that they reinvest, but if they don't put their own skin in the game, significant skin, we won't invest, no matter how else everything else looks. Another one is if they lie to us. We do NOI, net operating income audits. That's a third-party audit that costs $9,000 or $10,000 per asset. It doesn't come out of the investor's pocket, not a penny of it does. But we do that to make sure that everything they told us, or at least maybe the seller told us, and they're our client might be the buyer, that it's all really true. That's another one. Gut feel is another one. Gut feel includes, I think God created us with like 3,000 different receptors to pick up on, unspoken signals that we don't even know what those are, but they're there. And sometimes that translates into a funny, queasy gut feeling. And sometimes if they're a really big promoter, like they've got it all together too well, that's not a good sign. That's not always that way, but that's one. Of course, some obvious things, if they're taking risky floating rate debt, if they're counting on interest rates to stay low, if they're counting on, rents to go up 9.25% in Tucson the next 7 years, like they did the last 7, that's not a good, those are bad signs. And there's so many more. We have a 27-point due diligence process that checks out all that stuff and so much more.
It makes a lot of sense. And I love the 27-point due diligence process. I'm like, oh, we need to do an interview on that one, because I think that people don't, and I know maybe I sound like I'm being silly, but actually I'm not. I think people don't understand all the time when you say, hey, they're anticipating the rents to go up by 9%, just as they have for the last several years in Tucson, right? And that ends up being a red flag for you, but not everybody's going to red flag that because, well, it has been going up 9%. So, gee, that makes sense. But it's like, well, no, it doesn't make sense. Like I'm investing in Tulsa. And in Tulsa, the rents went up by 21% in 2020. Wow, isn't that amazing? Right? But how much did they go up last year? They went up by 5%. Right? So I could say, hey, if I was buying in 2021, I could say, the average of the last 5 years of rents going up in Tulsa has been using the 21% in 2020 as a form of raising that average across multiple years. And I project forward. But then that's not what's happening currently, right? So there's an inconsistency in that. What's happening currently is 3 to 5%. And so above a 5% increase, even maybe above a 3% increase, I project 3%, 2 to 3% increase, ends up being, I think, a little assumptive, but not assumptive because of the world in general or US in general, but because of what Tulsa's history has been. Then it's out of step with Tulsa's history. So sometimes it's hard for us from LA to be able to understand a Midwestern city and what that due diligence could look like, or what the numbers could look like.
Right. Yeah, absolutely. It's probably step on somebody else's toes, including our Wellings intern here today. But Warren Buffett said any company with an economist has one too many employees. And he also said, we're not interested in anyone's predictions, including our own. And this is kind of crazy, and it's hard to believe, but I got to take him at his word. Warren and Charlie said they never had one conversation in 59 years or whatever of investing together. They didn't have one conversation about the economy or any economic predictions when they made a decision to buy or sell anything. And they said that we're looking for durable products run by great management teams at prices well below the intrinsic value. And they said, if we can get those three things, we don't care what the economy is doing or saying. And that's what Wellings Capital is trying to do. We're looking for durable asset types like self-storage and mobile home parks run by great operators at, with a lot of intrinsic value. That means a lot of value add potential on the bone.
Okay. So hugely important. I have heard this before, Paul, but I have not really appreciated it as much as when you've spoken it right now. Because there is this sort of simplicity, right? A good house in a good neighborhood, right? Basically, what kind of housing do you want to own? A good house in a good neighborhood. Why? Because that's a B house in a B neighborhood. It works on the way up. It works on the way down. You don't have a lot of gangs. You don't have a lot of deferred maintenance problems. Good house in a good neighborhood. There's a reason why that works. What you've just said has a lot of depth to it as well, because when you talk about, a durable good means that it doesn't disappear, right? So it's not trendy. It's not going to disappear if all of a sudden we decide that, I don't know, I love prefab homes, but maybe they're not durable, right? But so it's not going to disappear suddenly, right? Run by good operators. Oh my goodness, I cannot tell you how much of due diligence to me is about, is it a good operator? Like, right? Are they telling the truth? Do they have the experience? How many full cycles do they have? What's their depth of time in the field? What's their commitment to their due diligence process? Or are they more committed to shiny objects? Like, who is that person? Because the person will take a good deal and destroy it, or they can take a mediocre deal and make it work really well.
Right. That's so important right there.
It defines it. It's not the deal. You don't want a stupid deal, but it's not the deal, right? It's the person who's defining it. But then you say that it operates, it has, what was it you said? The third one was, it's under market.
Warren Buffett said, price is what you pay, value is what you get. And we're looking for assets that have tremendous meat on the bone. In other words, they have a lot of intrinsic value that is not tapped into by the seller. And I can explain an example if you want.
Please explain an example, because I think there's something valuable in that.
Yeah, so I wrote another book on self-storage since we talked. It's called Storing Up Profits. And in that book, we talked about all the value adds self-storage has. So here's a typical value add. And this is a lot of examples in one. But the seller says, yeah, we've got this self-storage here in this acre and a half, but we got 6 acres out back we don't do anything with. And the buyer goes, great, thank you. So, the buyer can potentially gravel or pave that and put industrial self-storage, truck parking, RV and boat parking. They can build more units. There's a lot that can be done there. They can put a cell tower in the back. They can put a billboard in the front. They can put an ATM machine and a propane filling station out front. They can sell locks, boxes, tape, and scissors. They can put solar panels on the roof. They can build a new section of climate-controlled units or non-climate controlled units. There's so much that can be done to add value, and the seller typically doesn't have the desire or the resources or the knowledge to do all that. They're already making good money. They built it, 30 years ago. Some of them don't even have websites or even good signage. Now, all those things are potential value adds. And of course, the big value add is their rents are way below market. And I know sometimes they'll say, hey, I'm at 100% occupancy. I don't want to mess with raising rent. And well, that's not always the best strategy to maximize income and really build profits for investors. So that's intrinsic value.
It's a really good description, because it really starts to define the box of intrinsic value versus the economy, right? Using the economy to force equity out of something, or to count on that movement cap rate and buying at 7, but it's going to be 6% in the future. Well, now you're relying on something that you actually don't have control over. You can't make that decision, right? The decision is going to be made for you. You could start at 7 and it ends up being 8 in the future, right? So many of us have seen the black swan events, right? Things that all of a sudden, disappear out from under us in 35 years. Mine's 35 years. And you've been at it, longer than I have. But then when you describe the box of like, yeah, but I can control that I have a list of 7 things I could add. And I can take the time to confirm that 5 or 4 of those 7 things is really truly possible, to then decide that 2 of them is sufficient and implementable, right? And that ends up being something that we're adding. Oh, by the way, really our primary forced equity is the rents themselves, because the gentleman who's running it, or female gal who's running it, has lost the momentum, right? And so they call it professionalism, and bringing in professionalized management and being able to bring it up to the equity that it could be just if it was managed well.
Mhm. Yes, that's right.
So all within a box specifically that most of us as investors have some control over.
Yeah, right, right. I love all that. That's well said. We're doing something now called the pref yield because we're doing preferred. We're doing preferred and JV hybrid equity, and not rescue capital, to be very clear. But the pref yield is a number where if the cap rate decompressed, I'll say it that way, to a number at this number, what would it have to decompress to for us to lose our first dollar of capital? Because we're in the middle of the capital stack. We're not common equity. We're, let's say preferred equity in the middle of the stack, or JV equity in the middle of the stack. And so like the deal we're looking at today is $5 million multifamily. The cap rate is, let's say 6% to make it, just a even good number. That cap rate could go to 9.1% for us to lose before we'll lose our first dollar of our investment. And we love that because that means, this operator has all this track record of never having that happen. Well, that's a pretty, that helps us in our comfort level.
It does, but it doesn't necessarily solve it. When Warren Buffett again, when the tide goes out, you see who's swimming naked. And I think there's accuracy to that, but I also think there's people who, how do I put this? People who are good people with good assets that all of a sudden don't work anymore. And there's a single mistake in there that they didn't count on being so lethal. Just saying, right? And so I see people around me who I know are good people who I've, listened to and have trusted their opinion, and all of a sudden they're exposed. And I'm like, wow, that was a simple single mistake that has completely exposed you. And every cycle I see people I know, like, and trust who fall out of the market.
Every cycle. And that's where diversification comes in. The smart guy I told you came in from Dallas last night and had dinner with us. He said, I'll never put more than 5% of my money into any one deal because something will go wrong with some of them. And he was very tempted to go much, much higher in a certain asset. It turned out it was one of those bad ones. And he's so glad he didn't.
Yeah. One of the other things you talked about, because I want to anchor this, is where you put yourself in the capital stack, right? So the vulnerability, I think sometimes people miss the vulnerability of where you are in an investment, especially since what you have is LP investors investing in a business. Where they are becomes particularly important, because if they're part of the equity, then that lily is one of the first thing to start to disappear when a deal goes bad, is the equity. Then you get into the position of the notes, right? Because the notes are paid first, and the first position is paid first, and your preferred return, that place in the capital stack ends up being higher. And it's important that it's higher. So not only are you creating safety by being in your lane and what you're choosing, but also the position you're taking in that capital stack. And I've said capital stack several times because I want people to do their research on understanding what capital stack means and how there is safety in the position in the capital stack, almost regardless of the investment. Almost, because you can't disregard the investment, but there's a value. There's another box that you can tick, right? Of due diligence and safety, and having the boring investor having control over your risk instead of going for the equity, which is the big upper end part. Oh my God, I get 20% of the waterfall. Woohoo! You can go, yeah, but what if I just take away my 10? What if I just take away my 12% and call it good? Knowing that the cap rate has to expand to 9.5 before that deal goes bad for my position.
Right. Yeah. And that makes it,
I want to do the math of that so people listening could understand.
well, it makes it even riskier for the people on top, in a sense, because they're going to lose, potentially all their money. However, if things go well, and let's say there's 25 deals in a row that went well, it's likely they'll go even better because of the pref equity effectively it serves a similar role as leverage. It allows them to actually let their dollar go further if there's a positive outcome. A quick example of this is we recently invested in a multifamily deal in Odessa, Texas. It was $51 million. There was 30 million in Fannie Mae debt that was assumed. So there was 21 million in equity needed. We brought 14 and a half of the 21. The sponsor had to bring $1 million or $1.5 million of their own money. Friends and family brought about 5.5 or 6. And we brought the other, like I said, 14 and a half. And that means that 6.5 or so on the top end had to be completely wiped out before it cost us a penny of our principal. And, that could happen, but it's a more secure position.
Okay. Well said. I forgot that you weren't pref return, you were pref equity. So pref equity is a little closer to the equity position versus higher up in the capital stack. But I do think that's important as well, so that you're actually higher above the other equity, and that therefore you have to lose that 9.5%. I like to ask this show. I like to ask this question pretty much in every show. So and then we'll close it out. Real estate, as we just talked about, is not an easy field to be in. It takes a lot of grit, a lot of intention, a lot of just staying the course, learning to trust being the boring investor versus the speculator. Why do you continue to use real estate to break through to your financial freedom? It can be a tough field. Why use it?
Yeah, it could have been something else. And if I'd have got into something else, let's say it was oil and gas 30 years ago and stayed in that lane, I think I think we talked earlier about the importance of staying in your lane. For me, it was real estate. I kind of stumbled into it, and it's the one thing I know, and it's the one thing I want to stay in. Somebody asked me on a podcast yesterday, if you could tell your 25-year-old self, if you can give some advice, what would it be? And I'd say, well, stay in your lane the next 50 years. But in my case, I would have said, absolutely get in commercial real estate. There's no other place I know to build predictable wealth. And I'm defining wealth as having assets that reliably produce cash flow. And I can't think of a better place to do it.
Paul, thank you again for your wisdom. It's amazing to me, like a little dribble falls out of your mouth and I'm like, no, we need to expand that. People don't understand what's behind that. Just the simplest book. You started with one we didn't even touch on, which is don't do ground up development unless you know how to replace a doorknob. I'm like, there's so much in that. So thank you very much, Paul, for your wisdom, for your depth, for your grace, for your humbleness, for your simplicity, so that, you don't have the ego in the game. You really just have the willingness to be generous and giving and have success. So I appreciate that and admire that. So thank you.
Thank you. That's so kind of you. Thanks, Christine. I want to be back. I want to come back on your show every day.
Okay, you can go back on my show every day, Paul. I have no problem with that. We can do this over and over and over again. I'll keep expanding those dribbles of wisdom to go, no, you guys don't understand how important that is. But you will be at Phoebe, right? You've just agreed to speak at Phoebe in 2026. So I'm going to find a date and time for you to do that, which is great. And then we'll do another podcast at that point. So yes, you'll be back on my podcast because it'll be part of you being a speaker. And if people want to get a hold of you, Paul, they want to invest in your fund of funds, they trust your depth of experience, your simplicity, your wisdom, and the humbleness that you use to define your investor's success. How do they do that?
So you can reach me at wellingscapital.com. That's WELLINGS, wellingscapital.com. And I've got some fun free resources at wellingscapital.com/resources.
Thank you so much, Paul. This is Christina Suter with Real Estate Breakthrough. Delighted to have Paul Moore, Wellings Capital, one more time, truly a master in our field. And you can see the next show in 2 weeks.